What's up, Jay Martin here. Now, this is another interview focused on a highly controversial sector, and that is the carbon credit industry. Now, before you tune out, I published 2 interviews trying to understand the carbon credit market better, and both of those 2 interviews received an obscene amount of hate, and I understand why. We're talking about a new capital markets industry that is focused on reducing carbon emissions and therefore combating climate change, and I understand the controversy because half the internet doesn't believe in climate change, and the half that does probably believes it's some kind of moral sin to profit from it. So I understand, and I'm not here to dispute any of that. I'm not a climate scientist. I'm an investor, and I follow the money. And look, I promise you, I'm trying really hard to disprove the carbon credit market and prove that it's not going to work and is not sustainable. But this is not my first rodeo when it comes to an emerging market. And all the indicators that I keep on uncovering lead me to be bullish. I follow the money, all right? I'm an investor first. So today we're going to talk about the carbon credit market again. I think you should pay attention to this because I do believe this industry is poised to grow. So my guest today is Jamie Keech. Now, he's a partner at Inventa Capital, and he's the founder of Resource Insider. He's a junior mining guy. He's a mining engineer. I actually had him on the show today with the intention of running through my junior mining positions. I'm planning on consolidating these holdings right now. And where we ended up going was into the carbon market because he's as excited as I am. He's actually taken the chairman seat of a new carbon credit company. So we're gonna dive into this today. Once again, this is interview 3 in a series I'm doing, trying to understand the emerging carbon credit industry. And honestly, I'm trying to prove it wrong. I'm trying to prove to myself that this is not sustainable. I'm trying to be the cynic here, but I keep on seeing the indicators I've seen time and time again. So check this interview out. Let me know what you think. 3 things before we jump in. Number 1, the ad revenue from this channel is donated to an organization super close to my heart called Zero Ceiling. Zero Ceiling's mission is to end youth homelessness. They do this by giving at-risk urban youth the opportunity to relocate to a beautiful wilderness location and then provide them with supportive housing and influence. They do a great job. Number 2, I publish a weekly newsletter. I love writing it. It's free. There's a pinned comment right beneath this video where you can subscribe. I'd love to have you join the team. And number 3, if you prefer to listen to this content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. Okay, here is Jamie Keech. Enjoy.
This is Jay Martin.
What's up, guys? Jay Martin here, investor and CEO of Cambridge House, and I'm joined right now by Jamie Keech. Jamie is the chairman of Vita Carbon. He is a partner at Inventa Capital Corp and the founder and CIO at Resource Insider. Jamie, how are you?
Good, man. How are you?
I'm really good. Yeah, thanks for making the time. I'm excited to chat with you today and go.
My pleasure. Yeah.
Web of directions. For anybody who's not familiar, you've been on the show before, but for anyone who's not familiar with who you are and what you do, let's start with that. Who are you, Jamie, and how do you spend your time?
Yeah. Well, I guess going back to basics, I started my career as a mining engineer. I worked all over the world before moving to Vancouver about 7 years ago. Since moving to Vancouver, I've worked primarily in, I would say, the venture capital space of the mining world. That started with being the 4th employee at Equinox Gold, now a multi-billion-dollar gold company. We did, I think it was 7 mergers and acquisitions, going from $20 million to well over $1 billion in my tenure there. And then more recently, I've run for the last 4 years the Resource Insider newsletter. We're a subscription-funded newsletter. We don't take money from companies. All we do all day is we go out and we look for the best private placement investments that we can find in the natural resource and the commodity sector. I invest my own money in everything we cover, and our subscribers often invest alongside me. And so that's been a successful business and a really passion project of myself to run. And I've got to work with some of the coolest, most interesting investors and entrepreneurs I could have ever imagined. So that's been very rewarding. And then the last about year and a half, I've joined as a partner of a venture capital firm called Inventa Capital, based here in Vancouver. The chairman is a gentleman named Craig Parry, sort of a serial entrepreneur within the mining space. And at Inventa, we're doing, exactly what we were talking about before, is finding great projects, finding great teams, and helping incubate new companies. And I guess you just mentioned my newest role, which is chairman of Vita Carbon. Man, these are starting to add up now. My intro is getting longer than it was about a year ago.
That's why I let you do it.
Vita is the newest deal that's come out of Inventa Capital. And exactly what it sounds like. This is a foray into the carbon credit and the carbon offset sector. It is a company focused on streaming and royalties in that space. And we've had a shockingly incredible amount of traction and support in that sector already. We're only, about a year old, and it's gone really, really well. And there's a lot of exciting things happening.
Okay, I want to talk about a lot of that. So we're going to talk about Vita because I want to know more about the carbon sector. You're not the first person who's told me, you haven't said, I don't know if you mentioned this, but I know you're excited about the carbon sector, obviously, right? You're the chairman of Vita. Yes. You're not the first person who's been on this show who's been incredibly excited about an industry that I think very few people don't understand yet. And most people that talk about it are incredibly skeptical. I mean, I've published 2 interviews covering that industry so far on this channel. Both came out to a very weak response, and those that watched it were incredibly skeptical of it, right? And so, but I'm seeing all the indicators. I'm seeing a lot of smart money move in that direction. I'm seeing a lot of smart entrepreneurs launching businesses. And I've seen this rodeo before, right? Where you see the early stages of a budding industry, retail doesn't quite get it yet, or questions if it has substance, right? And then when that tide turns, that's when you want to be positioned. So I do want to talk about the carbon market. Jump in. You have something.
Can I turn the interview around on you and ask you, what are people most skeptical of? That's because we're seeing a ton of support, for example. So we did a private financing a few months ago. We were oversubscribed by a factor of 3. And I thought that this was going to get a lot of support. I knew that there was a lot of interest out there, but it has even blown away what I was expecting. So I'm curious to hear the other side of it.
Yeah, I mean, and that makes sense to me. I invested in Vita, right? And I'm excited about it. And I think that it makes sense that your audience would appreciate it because they buy into what you're doing. They know you, they trust you, you've delivered returns for them. So if you bring them carbon, if you explain what this market is, they're going to be, they're going to listen, right? Whereas,
but I'll take it one step further even because before we brought Vita Carbon or Carbon Deal to our newsletter and covered it in there, I was getting our members reaching out to me and asking, hey, what about this carbon thing, Jamie? Like, can you take a look at that? Meanwhile, we're like working behind the scenes, trying to get things done, trying to get things. But I had, probably a dozen people reach out to me and say, you should be taking a look at this. We'd love to invest in that. So there is that groundswell among a certain maybe subset of investors. But again, I didn't mean to cut you off. Sorry.
No, please. Yeah. And I would put myself in that bucket. I was really excited when I got the call that you were putting a deal together. And did not hesitate. However, I guess, so you asked me, what's behind the lukewarm response?
Yeah, what's the criticism?
Well, I can speculate. I mean, what's the purpose of the carbon credit industry, right? It's to help mitigate climate change, right? At a high level. There's more to it than that, right? There's now incentive structures and mechanisms in place to convince the world's biggest emitters to start investing in carbon reducing projects. But, at its core, right, what it endeavors to do is help clean up the planet, right? We're trying to be carbon neutral by 2050. Well, you put a piece of content out on the internet about that. First of all, half the internet doesn't believe in climate change. And the half that does, right, probably looks at capitalists trying to fill their pockets off of climate change as some kind of a mortal sin, right? So that's who you're talking to when you publish a video and put it in the abyss on the internet, right? You get everybody. And that's the response that I've seen so far. Yeah. What do you think about that?
I think it's an interesting point, right? And I think, the people that watch your show are primarily investors, I assume. Yeah. And I think what they need to be thinking about is not whether they believe in climate change or not, or not whether they agree with what's happening, but they need to probably be thinking about what is actually happening and how do you respond to this changing environment. Something we do know is that something about $39 trillion has been committed to being pulled out of the oil and gas space. So if there's ever been an indicator that sort of the most wealthy, most powerful, most well-financed corporates and capital allocators and funds and private equity firms, et cetera, of the world are shifting focus, I think that is it. And that money, that money doesn't just go and sit in a savings account somewhere, right? Collecting 0.1% interest. It's swirling around up there and it's looking for somewhere to go right now. And so much of it, I think, is being redirected into green energy, into ESG, into, for lack of a better term, the net zero trade. And if I'm an investor at home, you can have your political opinions, you can have your scientific opinions, but if you're an investor, your investment opinion should be, where is capital going? How is this going to impact markets? How do I take advantage of that? And I think anyone even remotely paying attention to what's going on right now has to see the net zero trade as something that's happening and is going to be getting bigger and bigger and impacting our lives, our portfolios, everything for, at least the next 5 years, very likely the next couple of decades.
Well, it would have to be, if we're gonna follow this thread towards, the Paris Agreement's goals of reducing emissions by 50% by 2030 and becoming a carbon neutral planet by 2050. If what I've learned is correct, that's about $150 trillion problem, right? To convert the world to carbon neutrality. Now, that's a speculative number, but it's, probably pretty close. Now, you said, what did you say? 39 trillion pulled out of oil and gas. Now that is what excites me, right? And that's what should excite investors. Exactly what you just said. And look, I'm no scientist or weather expert. I've spent enough time in beautiful, wild places that I appreciate what we stand to lose if we don't take care of this planet. But I don't need to understand the complexity of climate change to understand incentives. And when you say 39 trillion pulled out of oil and gas, it's from companies like BlackRock, the world's largest fund, right? Larry Fink, he's no snowflake, right? He manages over $10 trillion. And he's now said in numerous letters to his shareholders that they will be pushing his portfolio companies towards holdings that embrace zero emissions by 2050, and maybe dropping some that fail to engage.
I think he also said it's, the next 1,000 unicorns are coming from green energy companies. I think that's a quote from him as well.
Interesting.
That's attributed to him. These are unicorns, are $1 billion plus sort of startup companies, for example. And, honestly, this shouldn't be that much of a surprise to people. The idea of carbon offsets or carbon credits, there's lots of people that find that offensive as a sort of a tax. But are you familiar with a concept called the tragedy of the commons?
Explain it to me.
So if you took biology in high school, you might have come across this, but the tragedy of the commons is a concept that was developed by a British economist a few hundred years ago. And what was happening in Britain at the time is that the common areas, the area owned by the common people as opposed to the aristocracy, it was commonly owned and nobody controlled it. And what was happening is people were allowing their livestock to just run around, sheep, cattle, etc. And they ate all the grass and basically turned the damn thing into a mud pit. And so the common area got destroyed and there was a tragedy. So the idea of the tragedy of the commons is that if nobody owns something or has to pay to use it, there is no accountability there, right? And therefore, if there's no price to use it, everyone uses it to the maximal extent and it destroys the resource. And so this was changed. You had to pay grazing fees, you either own the land, et cetera, which put the accurate cost on the use of the land, which therefore protected the land. So that's the classic example. But you also see this again, in the 60s, 70s, 80s, when you were hearing about, water pollution. Where I'm from in Ontario, I think there was one section of lake at one point outside of Hamilton, Ontario, big steel town, which literally caught on fire because of all the pollution that was in the bay right there, right? And because at the time, companies in factories and plants, et cetera, were able to just dump, chemicals, waste, et cetera, into waterways because it was, the recipe to pollution is dilution and it's just going in there and it's going to wash away.
Sure.
That is another example of the tragedy of the commons, that people didn't realize that these lakes and rivers, and even to a lesser degree, but real degree, oceans, are a finite resource, and that you can't just pile an unlimited amount of shit in there and have no consequences. So what happened? Well, regulations came in place where you have to treat your sewage, you have to pay for this, that, and the other, which was designed to reduce the impact and the amount of waste that was going into waterways, right? So you have the grazing ground, which is a very local issue. It's the field in the local square or whatever. You have whether it's a lake or a river, it's a local or a regional or maybe even a national issue if it's the Great Lakes here in Canada. These were all addressed by regulations and fees and taxes, et cetera, to properly build in the pricing of pollution. So what's happening now is we're kind of just taking that to the next level, right? We're looking at what is the proper price of pollution for the atmosphere, and unlike a lake, which is a regional issue, the atmosphere isn't a regional issue. It's a global issue. And it's fine that, the EU is putting in a compliance system, or California or Quebec, and they have carbon credits there that you have to buy. But the problem is this is a global issue and it has to be addressed by everyone. And what I really like that's happening right now in the carbon space is this rise of the voluntary carbon markets. This is being driven by capitalism. This is being driven by markets. And it's an attempt to put, proper pricing on what it costs to pollute the atmosphere. And I think, that's just an important stage. And what we've seen throughout history is the evolution of properly impacting or proper pricing for impacting an environment, whether that's ground, water, and now air. And we've just gotten to the point where, 30 years ago, we were seeing the impact on waterways through, pouring chemicals in there. Now we're seeing the impact on the atmosphere by pouring chemicals in there. It is a finite, steady state solution, and it will change. And it has changed throughout time, but it's changing now, and we need to price what that's going to look like. And that's kind of my view on it, that it's not anti-capitalistic. It's kind of part of the process.
Yeah. Yeah, I agree. I wouldn't call it anti. I mean, I think it's a great example if it works, right? And I think we should get into the details a little bit because we jumped into carbon faster than I thought we would.
Sorry.
And so for anyone who's not familiar, I want to explain the basics right away. But, if what I'll say before that is if this industry delivers what's promised, it's a great vote of confidence in capitalism as a fantastic solution to a problem that we've been unable to solve or really make any notable ground on. So anyways, when you say, we're now able to apply the proper pricing structure, right, to these finite natural resources, talk to me how does the carbon sector work? What is a carbon credit? How is it created? Who needs it? Why do they need it?
Yeah. So there are really two carbon sectors. There is the compliance sector, and then there is the voluntary sector. So the compliance sector is what you think of when you think of cap and trade programs, right? This is in the EU has a compliance market. California has a compliance market. Quebec has a compliance market. And, very generally speaking, it's something like the government says a given company can produce X number of tons of carbon per year or greenhouse gases per year. If they go over that allowance, they have to purchase credits that are in that market to offset, the pollution that they're generating. So that's the compliance market. Those are their own unique ecosystems. What's really been taking flight over the last couple of years is the voluntary market. And this is exactly what it sounds like. It's voluntary. You do not need to participate, but so many big companies, wealthy individuals, pension plans, university endowments, etc., are starting to commit to participate in this due to the pressure of their sort of shareholder base or investor base, etc. And when you see, the Microsofts or the Exxons or the Tiffany's or whatever say, we're going to be carbon neutral by 2030 or 2040 or 2050, whatever sort of guidelines that they're setting, often it's going to be a big part of that is going to be participating in these voluntary carbon markets. And, for people who don't know what I'm talking about at all, it's very simple. So a carbon offset credit represents 1 ton of emitted carbon. So if you produce 10 tons of carbon a year from burning whatever and producing greenhouse gases, you would need to buy 10 carbon credits. And it really kind of acts to balance the seesaw there. And then
to become carbon neutral,
you are net zero, right? You're not gross zero. Gross zero means you emit nothing. To net zero, it means you kind of consume as much as you emit and you balance it out. So many things cannot become gross zero, right? Like we can all switch to electric cars. We can build, wind turbines and solar fields, et cetera, and reduce our emissions. But there's for example, there's the cement industry. The cement industry is responsible for 8% of all global carbon emissions, right? Of that 8%, half of it, so 4% globally, is just from the chemical processes that are required to make cement. So there's a lot of different industries like that. So it's a very, very complicated sector, and it's unlikely. I think it's unlikely we'll ever hit gross zero ever, frankly. And it's certainly unlikely we're going to be doing it anytime soon in the next 10, 20, 30 years. Yeah. So these carbon offset credits are really designed to help companies, to help society achieve these goals.
Right. So right now, the world is emitting something like 50 billion tons of carbon annually. Right. And so
that's the exact number.
That's the exact number. So gross zero would be that the planet is emitting zero tons. Right. Net zero, as you're saying, is say by 2050, maybe we get that down to 15 billion tons. We really work hard, right? And we're able to, we still got to offset 15 billion.
Because I actually was, sitting at a table in a restaurant when I first heard that number before we launched this company. And this is the kind of mental math that I did that really got me excited. So exactly that. There's 50 billion tons, okay? Every single year, 50 billion tons of CO2 are pumped out into the atmosphere. Let's say we all get our act together, we all become vegans and have solar panels on our house and et cetera, et cetera. Well, you're not going to eliminate all 50 billion tons. Let's say you can eliminate, 80% of it. You've got 20% left. That represents 10 billion tons per year. Okay. Right now, the average so you have 10 billion tons that would need to be set off by 10 billion carbon offset credits. The average carbon offset credit now is going for, very generally speaking, around $10. Okay. So that represents 10 times 10, $100 billion industry today. Okay. Assuming that. But most people are predicting conservatively that these things are going to be worth $40 over the next 9 to 10 years. Right now,
just hold on a minute. Right now, one credit is worth $10. Is that what you said?
So I said, very generally speaking, on average, they're worth $10, but they can range from 15, they can range down to, a few dollars, depending on where that credit comes from, what jurisdiction is located and how old it is. It's quite a complex pricing system.
Sure. But the reason
it's like 10 is average.
10-ish. We'll say 10-ish, not holding you to that number. I get it. You're saying you could speculate that number will go up to $40. Do you have any, again, guess, estimate, time horizon before that carbon credit quadruples in price?
So the predictions that I've seen say, and these are from sort of detailed market analysis, they're not just, some guy kind of licking his finger there, that it's $40 by 2030.
By 2030, that carbon credit will quadruple in price because the demand for that carbon credit from, airline companies, shipping and logistic companies, energy companies like Coca-Cola, which are never going to be carbon gross neutral, right? They're going to have to buy those credits if they want to get funds from companies like BlackRock, right? To get cheaper capital, get access to capital. They're going to have to hunt down, net zero. And so they're all going to be so as demand increases, that's what's going to raise the price, right? So the real simple supply and demand economics. Where does the credit come from, Jamie?
So credits can be created a variety of ways. So roughly speaking, there's two different types of credits or two activities that can create credits. There is sequestration, right? So you're actually pulling carbon out of the atmosphere. The most, common way of this is you're planting trees, right? You plant trees consume CO2, therefore they're sequestering carbon. That's one. And then there's reduction. It's that you're taking some sort of step that stops carbon from producing. And then the most common way of that is changing from, say, fossil fuels to renewable energy. And often, especially depending on the parts of the world, you'll generate carbon credits from that as well. So that's the two main ways that carbon credits are created. But, the creation of what I would say call quality carbon credits is actually, quite a complicated process. It's not really just a matter of me buying a forest and saying, I'm not going to cut down any trees, therefore I have carbon credits. There are actual governing certifying bodies that will evaluate a project, approve the plan. They will sort of use something called a methodology, which is basically parameters by which these projects are evaluated. And they say, okay, say this is a forestry project. The methodology is the RED Plus methodology, and you're planting trees in Brazil. They can say, okay, well, you're in this latitude, in this part of the world. These are the kind of trees that grow there. They grow at this rate. You get this much rainfall, et cetera, et cetera, et cetera, et cetera. Given all this, we certify that this project will generate 1 million credits a year for 20 years. And once that's certified, then that project will generate those credits. But even then, only if you do consistent monitoring, if you do consistent reporting and make sure that they're actually achieving their goals of planting certain trees and not cutting down other trees. So there is a really science-based rubric in place here to ensure that these things are generated. Because the whole concept of carbon offsets is the idea of additionality. And additionality essentially means, you should not be granted a carbon credit if what you were going to do, what you're doing was going to happen anyways, right? So, for example, you can't generate carbon credits from national parks by protecting national parks because national parks are already protected. You're not allowed to cut down trees there.
So what you would do then is you could identify a parcel of rainforest that is earmarked to be clear cut for the purpose of agriculture or development of some kind.
Yes.
And the community is going to take that because they need the economic stimulus, right? They need the jobs, they need the money, and they have no other option, right? So what you're saying is that now there's another option, right? A carbon, what do you call that? Who is just a forest conservation company? It could come in and say, look, we'll buy the rainforest from you. And the reason we can afford to buy the rainforest is because we're going to generate carbon credits because we're preventing that clear cutting, right?
So this is exactly what one of our portfolio companies that we have a streaming agreement with called EBCF is doing in Amazonia state of Brazil. This is a company. They went in and they saw this opportunity. There was a package of land that was destined to be clear cut. They went and purchased that. They protected it. They conserved those trees. There is a given methodology by which this sort of conservation projects can be evaluated. They brought in the verifiers from a group called Vera, and they certified this. And now that is actively generating credits every year. So that's exactly what's happening.
Okay, so I'm trying to put myself in the shoes of the critics who are then going to say, okay, great, right? Rainforest protected, that company's getting carbon credits and they're making money off that, but the local population doesn't have the jobs they would have had, right? So is it not a disservice to those locals who right? Like you took that away. Well,
that's a good question. And in most of the sort of deals that I've seen, if there are local populations and communities, depending on how remote it is, a lot of the companies are trying to integrate them into this. So the communities will often get a percentage of the revenue generated by credits, or they'll reinvest a portion of that revenue to try to sort of reinvigorate traditional industries, such as the harvest of acai berries or Brazil nuts. So normally they have these sort of additional factors that they put in there, where a lot of this money goes to invest into improving the life of those communities and the economic sort of fortunes.
So let's use your Brazil example for a little bit. Can we dive into this deal a little bit? I'm curious. Can we do that? Okay. So talk to me about the stakeholders, who owned the land and who purchased the land.
So who owned the land? It was permitted to a forestry company. Okay. EBCF, the private company, purchased the land. And actually, very coincidentally, have this exact slide open on my presentation in front of me on them. And so they have their sort of some of the additional aspects that they're adding here is they're protecting 342 animal species protected. They're protecting 146 species of flora. And there's 400 families in 15 different communities in this region that are also going to benefit from this as well. and they use the sort of United Nations standards by which to protect that. And so they have on here, and I have to count this up, 1, 2, 3, 4, 5, 6, 7, 8, 9 of the standards set out by the United Nations of how they're adding value. So they're helping to alleviate poverty and hunger. They're helping to improve the health.
Does it say how? How are they alleviating poverty and hunger?
So this actually does have this on their website. It's EBCF. And we could go through that with you, but I would have to pull it up and go through exactly all the programs.
Okay, but they're transparent about it on their site. So
yeah, absolutely.
And I support this. I mean, I like I said, I've been a huge benefactor of my time spent in all places, tons of time spent in very small towns with healthy wildlife populations. And I appreciate what we stand to lose. You know, I as the investor, I mean, wants to put myself in the shoes of the critics though. And so when I say it's great, you're protecting the rainforest and I understand the carbon implications of that. But what about the locals that don't get those 20 years, the 20 years of employment that would have come on the back of whatever project would have occurred? I guess, you know, the purchasing company, EDCF, it's not a given they get to buy this land. They have to take a proposal to the owner, whether it's government, community owned, and it has to be competitive with whatever else is on the table, right? Competitive enough that they'll take that deal over the palm oil plantation or whatever else could have gone in there.
Well, I'll give you a very specific example, actually, of another deal we're looking at right now in Latin America. I'm not going to tell you exactly where it is, but this group is doing something very, very similar in this Latin American country. And what they've done is they have a revenue sharing agreement with the local population, which is an indigenous population. And not only does this indigenous population get a very sizable percentage of the revenue generated from the sale of these credits, a lot of the money is also invested back into the economy there to help promote kind of what you would call traditional forestry industry. So in this part of the world, they harvest Brazil nuts, for example, and this is something that they're helping to encourage as well. So I think you're right. And when negotiating these deals, you know, this is something you really need to be considerate of and aware of, because at the end of the day, they have to be economic successes for all the stakeholders involved, right? If you're going in and protecting this forest and making millions of dollars or more per year off of the sale of the credits, you know, there's going to be unhappiness. There's going to be potential revolt from the local people there, right? Who kind of feel like their resources being taken from them. So the smart partners, the smart operators in these part of the world are building community partnerships. And it's kind of important to note that like carbon offset credits are a bit of a hot sort of space right now, but they've been around for a long time. They've been around for over a decade. So most of the companies, even the private companies that have gone into these areas in the past, they weren't, you know, minting huge amounts of cash doing this. They were often doing this as a way to help local communities and to protect forests. You know, they had a very altruistic sense to begin with, because, you know, until recently, the wider investing public did not consider this an area that was potentially very lucrative.
Can I draw some parallels? And I may butcher this, but you let me know if they ring with you. You know, when I hear you talk about this, I'm a member of the cannabis industry. And I think about the OGs in the cannabis industry that were, you know, I'm talking about, you know, sure, the entrepreneurs, the activists who were doing it before it was cool, right? Doing it for more altruistic reasons, right? But it takes money to really move the needle on things, right? And eventually that occurred, right? Due to legalization and licensing, right? And that's when suddenly that industry changed overnight. And that's kind of what I'm seeing here. Like, you know, how are you supposed to sustainably protect the environment without financial incentives? Like, I wish we just could, right? But what's going to create that sustainability?
I mean, I tend to agree with you. I think that's a really apt analogy, right? So there have been people that have been doing this for decades because it's been a passion project, but now the economics are kind of starting to align, and it's, you know, the biggest investors, the most sophisticated banks and funds, et cetera, of the world are looking at deploying capital into this space. And it's going to change a lot, right? The whole the whole structure of this sector will change with that flood of capital, that access to money, the level of sophistication of the players. It's all gonna adjust, and it's an area that's very much in flux right now.
Okay, so I'm convinced. Let's say we provided enough information for my audience to get it a little bit, and if you're listening, I didn't anticipate the conversation going this way, to be honest with you, Jamie, but I'm happy it did, because it's an industry that I'm really thirsty to know more about. I'm really curious about this, and I love it. So yeah, full disclosure, you're the chairman of Vita Carbon, and I'm an investor. I wrote a big check. Let's separate ourselves from that a little bit. Talk to my audience who says, okay, I believe you that carbon is going to be a phenomenal investment opportunity in the years to come. And if so, they're going to see a crazy amount of deal flow and opportunities. And if so, probably most of them aren't going to be very legitimate or do what they say they're going to do. I mean, that's the nature of startup investing. Most things don't work out. So do you have some simple ABC rules, some words of advice that you could leave with my audience right now that say, okay, you're looking at a carbon deal, here's what you should look for. Here's a red flag you should look for as well. Yeah.
Okay. I got 3 things. All right. You want to be thinking about team, structure, and assets. Team, structure, assets. Okay. Let's start with team. This is the most obvious one. With any venture space in Canadian markets, what happens when there's a hot sector? 1 billion people rush into this. They start as many companies as they can, as fast as they can, and they try to lock down as much capital as they can, as quickly as they can. We saw this in cannabis. We saw this in crypto. We've seen it, in mining every 10 years, and we're going to see it in the carbon space as well. And whenever this happens, it's a wide base of people entering this. And as time goes on, there's going to be fewer and fewer, and there's going to be big winners. And then there's going to be not such big winners and probably a lot of losers. So what we did, I'll give you an example. When we started Vita, we entered this space and we said, we're coming from a finance background. We're coming from mining background. We understand how to, build and run and finance public companies. We understand how to close deals. We understand how to work in emerging markets, but we are not carbon experts. So our number one priority before we ever went looking for any deal, before we ever tried to close a transaction, was figuring out, how do we build a team? How do we find that technical expertise that really gives us the edge, not to get one asset, but to build a pipeline of assets, to evaluate them, to implement them, to commercialize them, to all these things that have to be done. That was our number one priority. I'm a mining engineer. I'm a technical person. I have a lot of respect for technical skill sets, and I understand the ones that I have and the ones that I don't have. So we wanted to find people that could backstop that. So what we did, we went out and we partnered with a group called Clear Blue Markets. They're our biggest shareholder. They have decades and decades and decades of experience working in carbon markets, finding projects, evaluating projects, implementing projects, selling offset credits, working with the biggest buyers in the world for credits. We made them the biggest shareholder of our company. They've invested a lot of their own money, and we've integrated their technical team into Vita. So that was our number one priority. Now, I'm not just using this as a chance to talk about Vita. The reason I highlight this is because anyone who's listening to this, anyone who's thinking of investing in this space, if you're in this for the long run, if you want to find the companies that I think will have the chance to have the biggest winners, find the people that have been doing this for a while. And that's going to be harder to do than you might think. And the problem is that until very recently, carbon has been a really tiny space. There's not been a ton of capital flood in there. And as the problem with that is there's very limited expertise. And right now there's a rush for talent. So the biggest banks and funds and trading houses like the Trafiguras or the Glencores of the world, they're all trying to build carbon desks to take advantage of this market. And there's just not that many people that have expertise. So there's going to be a lot of companies that start. They're going to be repurposing investment bankers or biologists or whatever you have as carbon experts. But I would say if you're going to invest a serious amount of capital, do some actual digging into the team and make sure that they actually know what they're doing. As time goes on, more people will develop the expertise. But if you're kind of looking for that first mover advantage, I'd say team is number one. Okay. Number two, I said is structure. You need to think about how you want to invest in this space and what kind of company you want to invest in. So the way we are doing it at Vita is primarily by the royalty and streaming model. Anyone who's been investing in gold or mining knows the advantages of royalties and streaming. You kind of get the upside, whereas your downside is massively minimized. You don't have to pay for operating costs. Your capital costs are massively limited. You're not actually out there operating the projects. The reason that we did that was because we knew, we didn't know how to run a forestry project in Indonesia or in the Congo or in Brazil. Our goal was to find the teams that had done that extremely well and finance them and take advantage of their expertise. This does kind of come back to teams, but I am saying, think about if your team you're investing in has the expertise to deploy capital effectively in the structure they're using. If I was going out and saying, hey, Jay, I'm going to go start planting trees in Brazil, you might want to think carefully about that because that is not my expertise. And we don't have the team for that expertise. We have a team that's good at finding partners and effectively deploying capital with those partners. So look very hard at the business model, the structure of the companies you're investing in. And finally, assets. They need to be good assets. They need to be generating carbon offset credits. Just because somebody has a forestry project, just because somebody has a high efficiency cook stove project, which is another asset class in the carbon sector, it doesn't mean that those things will necessarily ever produce offset credits. They need to be able to get that certified by the different verifying bodies. And this is not an easy process necessarily. It's a highly scientific process. A huge portion of the projects that are put up or are requesting certification are turned away. They're saying, you don't meet the requirements for X, Y, Z reason. The other thing is, even if a project is certified to deliver, say, 1 million credits a year for 20 years, it doesn't mean they actually will. You actually, the operator has to kind of squeeze those credits out of there by doing proper monitoring, doing proper reporting, making sure they're doing everything they say they're going to do. And if they're not able to do that, they won't be able to harvest the credits. So find high quality assets that are run by really experienced teams in a structure that they know how to execute on. That's the very simplest way I would say to focus on the space. And that's what we tried to do.
And I think you listed it in the appropriate order because depending on how much time you have to do diligence on your investments, if you only have time to do one, pick the people, in my opinion, right? Pick the people. And that's something, the reason I say, I know I'm biased because, we play the hand that we're dealt, right? I talk to people for a living, right? That's what I have access to, right? I'm not a mining engineer, not a geologist, but I invest in the resource sector, not a scientist, but I invest in the health science industry, right? I invest in food tech. I can't grow anything to save my life, but what I can do is diligence on the who, right? I can look at who's in the driver's seat and their track record. Have they delivered before, right? Like and do they surround themselves with other great people? You can look at the executives and the directors and look at their resumes. That's public information for a public company. Anybody can pull that up. And a perpetual, almost made it individual is leading the charge. Like, I don't know if you want to bet on that, that almost. Look, okay, so let me think about this a little bit. What's the long-term development of this sector? As you're talking about this, I'm thinking, you specifically mentioned the race to talent right now because there's tons of cash flowing in. Demand is probably going to skyrocket if these forecasts are correct. Yeah. So the demand for more credits will be bananas. Everyone's going to want to be able to generate them. There's only so many people who can do it right now because it's an emerging industry. At what point does a Coca-Cola just say, we're going to build this in-house, right? And they're going to look, optimally at somebody like you and say, we'll just bring you in. Or does it make sense for the world's biggest emitters, the cement companies, right? The big logistics and utility companies to just build an in-house carbon credit division? Can you see that happening one day?
That's already happening. That is happening.
Got it.
So the big traders like Glencore and Trafigura, the big utilities of the world, the big oil and gas producers, they are very aggressively right now building carbon teams. They're scouring the globe for people. Now, it'll be up to them how they decide to execute on that, right? Are they going to buy carbon credits just on the market at sort of spot price that are available? Are they going to buy long-term offtake agreements from producers? Are they going to buy it from a company like Vita, for example, or have agreements with us? They'll all have different strategies. Some of them will probably try to incubate their own projects, whether they're protecting forestry and whatnot. But that's all going to happen. And there's a lot of money kind of flooding into this space in capital markets, but even more outside of capital markets right now, too.
Interesting. Mm-hmm. Okay.
But, it's going to be a big space. Like if we go back to that number, right? Conservatively, 10 billion tons of greenhouse gas emissions need to be offset every year. If it costs $40 a credit, think about that. That's a $400 billion industry per annum, per year. To put that into perspective, the rough estimate of gold is $150 billion per year, right? So this is like more than 2 times the size of gold, right? And when I look at the gold space right now, what do I see? I see the streaming and royalty companies in there. I see the Franco-Nevadas and the Wheaton Preciouses that are 20, 30 billion dollar companies, right? So I think this is certainly going to happen in the carbon space. There are going to be massive carbon credit companies in the, $50 billion plus category. But it depends, how things go the next couple of years, who that actually is. But, taking it back to gold again, when I look at, the most successful royalty and streaming companies in gold, the one thing they really have in common is that they were first, right? Why is a Franco different than a Sandstorm? Why are they almost 20 times the size? Well, they started way earlier, and they had this first movers advantage to picking up projects before people really fully appreciated the value of royalties and streams in the mining sector. They kind of scooped them all up. So that's starting to happen right now in the carbon sector. There are lots of companies that are rushing to market. There are lots of companies that are raising capital aggressively, some of them very, very successfully. But the race to money is one thing. The race to projects is the other thing. So if you're thinking about investing in these things, find the company that's able to consistently execute on finding and doing deals on great projects. And most going to market right now, this is shocking to say this, but from what I have seen, most going to market right now do not have any signed agreements on projects in their portfolio right now.
I'm glad you brought that up. The rush to projects, that's the other side of the business. And it's easy to think that, well, it'd be infinite. Like there's no shortage of parts of the planet we need to protect. So, but there, of course there is. It's finite like everything else, right?
Yeah.
And so, what you're talking about is the low-hanging fruit being scooped up quickly, right?
Yeah.
The cheap options, right? Like maybe purchasing rainforest in Brazil seems expensive today, but compared to how you're going to create a credit in 10 years when all the the rainforest has been earmarked for development is taken up, you got to build some sophisticated technology that's going to absorb carbon from the atmosphere somehow. How are you going to create that credit? That's really,
and as money floods into the space, Jay, like the margins will get squeezed out, right? What are gold royalty companies looking for now on returns? Like 2 or 3%. It's like the buying a new royalty today is almost impossible because it's a very mature, sophisticated market. There's a lot of money available for it. The glory days, in the 90s, they're over.
In the gold sector.
In the gold sector. Sector. And I would say, I would contend that is just starting now in the carbon space.
Yeah. Interesting. Can I ask you, Jamie, have you seen anything really exciting and innovative in the carbon absorption industry? Has anything caught your eye? Like any very creative technology or very effective technology?
Yeah. It's not something we've been focused on at this point. This is not really where our business model is. But one of the most interesting stories I've seen that kind of playing in this space for the last couple of years is what's going on in your hometown in Squamish, British Columbia, a group called Carbon Engineering, which are backed by, some of the biggest, most famous investors in the world, tech billionaires, et cetera, that are actually building plants designed to, they're $1 billion plants designed to actually suck carbon out of the atmosphere. So those guys, it's pretty cool to see a small town company in BC be really a world-class leader and innovator in this space. So that's the one that comes to mind. I don't know if you've heard about them or interacted with them.
Yeah. Well, it comes up. I mean, Squamish, 20,000 people live in this town, man. So yeah. I hear about that a lot. Yeah. I love that you brought them up. Okay. Now, another parallel, and it's actually going to segue us out of the carbon business. I told you I'd keep you for 30 minutes, so we're way over that. Are you good? You just give me a wave.
Are we good? What time is it? I'm good. Let's keep going. Yeah.
I do this all the time. Okay, you just let me know if you got to jump, and I'll wrap it up.
Yeah.
But what struck me is, and I'm talking my book today, once again, reminder to my audience, I don't give investment advice. I never tell people what to buy, but I'm happy to tell people why I did. In fact, I love to. So we're going to talk about a company called Nova Royalty right now, because what you just described is similar. And what caught my eye with Nova Royalty, now, just for context, Nova Royalty is a base metal streaming company, meaning they operate the streaming business model, but they purchase copper and nickel, right, from copper and nickel mining companies. They don't take on the risk of looking for a new mineral deposit, having to build a mine. They're not exposed to volatile metal prices because they're just purchasing right future output. What struck me about that is that I want to invest in the renewable energy trend, right? And if I look at the opportunities, right, it's early days still in this industry. And so when it's early days in anything, it's just hard to predict what's going to move. And so people rush into cobalt, for example, and then it turns out cobalt's really, really tough to get and can be engineered out. People rush into lithium. Turns out lithium's super, super abundant, right? And maybe not the smartest bet. Now, this stuff could change tomorrow, right? It's changed a couple of times. Whereas carbon is the conductor. Like, you're not going to ever engineer carbon out of electricity. Well, maybe, but
copper is the conductor.
What did I say?
Carbon. You got carbon on the brain, man.
Yeah. Okay. Well, you know what I meant. Thanks for catching that.
Yeah.
And so Nova Royalty appeared to me as the proxy to invest in renewable energy, right? And this is a company that I didn't get in early on at all, right? I actually just continued to dollar cost average in because I felt so confident in their business model. I've had the CEO on here a bunch, and I just like him a lot. I trust him, to be honest.
Back to Alex is a great guy.
He's a great guy. And I continue to buy Nova. The last time I had Alex on, I told my audience, I'll buy more 24 hours after this video is published. And I did, and I'll continue to do so. So I think, are you a shareholder of Nova? If so, can you talk to my audience with a bit more detail about what they do and why you like it?
I am not a shareholder of Nova, but I wish I was, actually. I think they've done a phenomenal job. And Alex, approached me about Nova early on, and I listened to him and I liked it. And I thought it was a great idea. And, like what happens sometimes, I got distracted working on something else, and I never invested. And I've kicked myself hard about that ever since, because him and his team have done really, truly a phenomenal job. And I mean, the short answer is, it's, as far as I know, one of the only copper royalty company out there. And they've done something that has been popular in the gold space for decades now, and they applied it to copper, which, in hindsight was a very, very obvious thing to do, and no one had done it successfully. And I mean, this is happening in the royalty space as a whole, right? There's also Uranium Royalty Corp, which has come out in the last couple of years. With Amir Adnani and his team having put that together, another huge market success. And part of it just comes down to royalties being such a great way to get exposure to a given commodity. It's such a great way for investors to get upside exposure while minimizing the risk. I don't know if we're getting beyond sort of a little too financial for what people want to hear. But, an average mining company trades at less than net asset value. So net asset value is basically the value of those assets in the company. So in the case of a mining company, it's a mine. Now, often a mine, will trade at 0.75 NAV or sometimes half of NAV. And that's because they're trying to calculate in risk there. They think there is such a good chance that something's going to go wrong, or the costs are going to overrun, or it's going to be delayed, that they're building that into the financial estimate. So mining companies, notoriously trade at less than NAV. That means the value, the asset is actually worth more than the company trades at, which is a little bit crazy when you think about it from an investment perspective. Royalties, on the other hand, are the exact opposite, because you can't have a cost overrun on a royalty, right? You buy the royalty, then you get paid whenever that mine generates revenue, whenever that mine it produces gold. So your downside from that point is zero, and your upside is, seemingly not infinite, but it can go anywhere from there. So royalty companies, I should say, trade at 2 to 3 times NAV. So if a royalty is valued at $1 million, throw it into a public company and it's going to trade at $2 or $3 million. It's a beautiful, phenomenal financial structure that has made a ton of people a lot of money and is just like completely overtaken the mining sector over the last 20 years. So gold was where it kind of originally started, originally led by Franco-Nevada. Now we're seeing it in uranium. Now we're seeing it in copper. Probably the most, well-known base metal royalty company is Altius Minerals. They now have a sustainability company where they're doing royalties on sustainable energy, solar panels, wind farms, etc. So this is a model that capital markets love, investors love, and we're starting to see it applied to a variety of things. And, I always say, for people that want to get exposure to the gold space, but they don't want to spend all day doing what you or I do, Jay, and doing private placements and doing research and talking to people, buy a couple of the major royalty companies in that sector. And, it's going to give you probably pretty good leverage to the commodity price, and it'll massively protect your downside.
I mean, that's exactly what I did, right? That's why I purchased Nova, right? And that's it. And why they came to mind, just to backtrack, is because you were talking about the race to projects with the carbon streaming business, right? And that's what struck me about Nova, because now there are a handful of copycat copper and nickel royalty companies, but the best projects in the world are already locked up. And in my opinion, in Nova, and that's you can't replicate that, right? Once great assets gone, it's part of a finite group. You can't replicate that. So,
and there's another problem too, right? Like copper is trading near all-time highs. There is no illusion that copper is like, everyone knows that copper is an extremely, extremely valuable commodity right now. Some of the biggest investors in the world are desperately looking to get their hands on it in as big a supply as they can. And copper companies don't need to sell a royalty right now. There are cheaper forms of equity or cheaper forms of capital for them, be it equity, be it potentially debt. So, selling a royalty from a company's perspective, it's not always the best choice. Often you're giving away a tremendous amount of value. So that tends to happen at the bottom of the market. If copper was trading at $2 a pound versus closer to $5, then I think, there will be a lot of royalties for sale. But, today they don't really exist to the degree they would have a few years ago,
right,
when Nova started.
Right. And what would be a trigger point for the price of copper to collapse? What would cause that, Jamie?
What would cause the price of copper to collapse? I mean, it's hard to imagine right now, right? Like, there's so, if we
you can speak hypothetically.
Yeah. I mean, I don't know what would cause it to collapse. We would completely need to readjust the direction of society, right? Talking about earlier, this whole narrative of moving towards net zero, ESG, if we are going to electrify the world, I mean, copper is the number one element that's going to benefit from that, right? It's not just in electric cars and battery production, et cetera. It's the entire power grid is going to need to be upgraded. And copper is like really the only feasible metal for that. I think like the replacement cost of copper needs to be approaching like $7 or $8 to $10, something like that. So we would have to basically say, scrap it. We're not hitting net zero, fire up the coal power plants and forget about it. I think that would be one of the main driver that I could see killing the copper price. Is that possible? I mean, nothing's impossible, but I would say it's unlikely.
Yeah, not something that I'm going to bet on. Okay.
Yeah.
All right, man. Look, I also wanted to chat through my junior mining portfolio with you and get your eyes on some of my positions, get your thoughts. We're going to do that another time because we just...
Should I get some cards to hold up and I rate them 1 to 10 maybe?
We could do that 100%. That'd actually be pretty fun. I would know what to sell. I'm going through that process right now. I want to consolidate. I'm holding too many stocks in the junior mining sector and I want to consolidate. So maybe I'll have you on again real soon. We can do that. It'd be kind of fun. Okay, dude, look, thanks for coming on. It was super fun chatting with you, Jamie. And just diving into this market more and trying to understand it personally.
You mentioned earlier, the importance of choosing the right people. And, I think that's really where shows like yours do such a tremendous value for investors, and you guys are doing a great job. And, I've learned a lot watching your show, and I know you're adding a lot of value there. So thank you very much for having me.
Dude, that's super kind to say. I appreciate it. I love doing it. Okay, guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. But coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational, and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The J Martin Show.